Do is and I have included so much content today, and it is so very important that this message get out there. I'm actually going to run this show on Friday, April 30th, and you might also be joining us again on Friday, May 7th. Again, because today is a very, very important show. I've got a lot of information about taxes, about things that you need to be really, really aware of. So without wasting any more time, let's get right into it. So today I'm going to cover the vaccine update, labor, tax changes, housing, stock market, and the econ map. Hey, let's jump into the vaccine tracker. We're on a good track right now. As I said before, the first virus was approved on the 14th of December 2020. And as you can see, as of April 30th, again, if you're watching this on the May 7th, this is as of April 30th, we are cranking out. We've got 143 million doses already out there, and we've got 71.49 doses per 100 people. And as you can see with the crossouts, those are the prior weeks. We are cranking up the scale, and we're still on schedule as the algorithms that we've built have played out, that the vaccine should be hitting all states and somewhere in the 80-85% efficiency ratio by November, which does a lot good. It's very helpful for our economy. On the labor front, though, we haven't really made any gains. Last week we had 547,000 new claims. We upped a little bit this week to 553,000 new filed claims, and we're staying and hovering right at about 5.7% in unemployment. Here's the big thing we're going to talk about today is taxes. And this has been the big media news, but a lot of people have questions on how will this really affect them? What will the corporate tax change do to us? Now, the stock market is very different than the labor market. There is some similarities, but the stock market doesn't necessarily need a lot of the same things that the labor market needs, nor does it have a lot of the same effects that it has on personal taxes. So let's say, as an example, you have a question of, well, if the corporate taxes increase and we become less competitive as a country and more companies pay more money to the government, won't that increase the actual or decrease the actual earnings? Yes, it will, without a doubt. But if we look back, here's the last four major corporate tax increases: 1950, 51, 52, and 68. However, during those increased years, the year after, the average return on the S&P 500 was 12.9%. However, the average rate of return on the S&P 500 since 1945 has been 9%. So we know that there's not a direct, immediate correlation to the tax increases. It doesn't mean that that doesn't affect it over greater than 1 year period of time. Again, you got to look at the data that's being presented in any analysis. However, what it will do is the goal of the government at this point is to raise taxes on everyone. And I know everybody is sat back, and I hear this over and over again. People are taking an ostrich on the railroad track approach. What I mean by that is people are constantly saying to me, well, that won't really affect me because I don't earn greater than 400,000. It shows the power of the political statements that people remember, but it's not truth. I've been doing this close to 4 decades, and I can tell you that not one single politician, whether they're Republican, Democrat, whatever, has told the truth when they said that they're not going to raise taxes. You can probably remember those days when George Bush said, read my lips, no increase in taxes. Well, he had to eat his words a year later. But again, Biden said no additional taxes for people under 400,000. If you watch what he said, he actually said, I'm not going to increase the tax rate for people earning less than $400,000. Doesn't mean that they're not going to pay more taxes. Those of us that actually prepare tax returns know how the government does this. It's sneaky because what they do is they do it on the back end. So they may keep the tax brackets exactly the same or not increase taxes for those people under 400,000. But what they do is they call what I refer to as trigger taxes. Trigger taxes are when they create a back end. It could be alternative minimum tax. It could be a tax on Medicare. It could be an increased tax on Social Security. It could be a decrease in the amount that you can deduct on your itemized deductions. It could be decreasing the amount of standard deduction. See, all these things, they still will increase your taxes whether you're making $400,000 or not. But how this correlates to the stock market is if I have a capital gains tax that doubles, even though the stock market may go up, and even though people may be making profits in the stock market, your profit is reduced. So you can look at that as a non-correlated loss in the stock market. It means the market might go up, but it means that you might actually lose money, or you might have a lesser return while you're still taking the same amount of risk. And again, the goal here is to take the least amount of risk with the highest net after-tax rate of return. And this is one of the things that always just irritated me about the wealth management business. There's all these financial advisors and wealth managers running around, and they claim to, be wealth managers, but they'll say, well, we can't offer any legal advice, and we can't offer any tax advice. Well, if you can't offer tax advice, other than just, maybe tax harvesting or dividends or things like that, but if you can't actually offer tax advice, how are you claiming that you are a wealth manager? So I believe that if you reduce the amount of risk that you have on your investments, but you apply true tax planning strategies and tax advantages, not just deferring through IRAs. That's ridiculous. I mean, my gosh, even what's that old saying? Even a blind squirrel can find a nut every once in a while. I mean, anybody could go online and go, how do I save taxes? Well, I put money in an IRA. I put money in an HSA. That's deferral, which we're going to get to in a minute. The key is to understand that when you want to increase net rate of returns, you got to work on your tax planning. So here's what's coming down the line with capital gains tax. The proposal right now is that capital gains tax will only affect people that have $1 million of income or more. But the problem is it's going to increase the tax to 43.8%, but it triggers other taxes. It's not just if you have $1 million or more, because you could have $1 million or less and have a capital gains, but it triggers other taxes, because what they do is they include that in something called modified adjusted gross income. That affects Medicare, affects Social Security, affects tax rates on other kinds of income. It affects recapturing. There's all kinds of related taxes that it doesn't just mean that you have $1 million or more of income. But what it does mean is that you look at how they're rigging, I'll use, the IRAs, and how you must take, and beneficiaries must take out an accelerated amount because they got rid of the stretch IRA, and you'll now see how they're going to stack the deck and make us pay more money even if we didn't have a true $1 million of income. We could liquidate a property, and with the loss of the step up in basis or the loss in the deferral, now what happens if I sell maybe $1 million property or $1.5 million piece of property? I got over $1 million in gross income. See, it's not net taxable income. They can use the gross adjusted income to calculate this higher tax. Again, I've been stating this now since I started doing this show. It's not about what the politicians say that they're not going to do in the front end. It's how they rig the back end calculations. They got to raise the money, right? So here's the step up in basis removal. What is step up in basis? Well, let's say that let's say that I have a family farm, which we're going to get to in a minute. And that family farm I have inherited through 150 years in my family. So the cost basis is nothing, right? They might have paid $27 in gold for it in the 1800s. I don't know. I'm just using the example. It could also be that I buy a stock and maybe I put $50,000 into it, but now it's worth $200,000. Well, if I pass that on to my kids under current law, they can inherit that $200,000 with zero tax. They get a step up in the new tax basis at the value at the time of my death. Well, the administration is looking at completely getting rid of that. So anything that passes on then to the beneficiaries will be taxed. Again, this is just really a convenient way to sidestep the estate tax, right? Everybody thinks, well, you got to be wealthy to have an estate tax. Well, right now you have to have greater than $22 million. Now the estate tax is going to sunset. That means that that current law of $22 million is going to expire in 2026, and 2025, expire in 2026, depending on when you die, and it'll move back to $5.7 million. With the accelerated stock market increase, with the accelerated increase in housing, people that own businesses, when you accumulate all that together, there's going to be a lot more people that have more than $5.7 million that will be affected by this. However, just about everybody is going to have, no, not everybody. I mean, if you don't own a house, if you don't own any stock, if you have no IRAs, if you have no real estate, well, no, you won't be affected. I'm talking about everywhere from the low middle class, middle class, upper middle class, to the wealthy, to the even the ultra wealthy. They're all going to be affected by this loss in step up in basis. They're also going to be affected by the loss of the transfer exception, which we'll talk about in a minute. So again, when we pass away, this loss in the step-up basis is added on or stacked on to the accelerated tax that they just passed on IRAs. Again, I talked about this last week and the week before. The Secure Act that was passed in January of 2020, we thought that we had 10 years to mitigate the taxes taken out. But as of April 9th, the IRS has commented we still have to take out RMDs, and then the remaining balance has to be taken out at the end of the 10th year. And depending upon if you're under 72 years old or over 72, that will determine what the RMD is. So that is a huge, huge tax balloon, tax bomb. That's probably the best word to use for it. So again, you can still plan around these things, but you have to have a plan. The ostrich in the sand on the railroad tracks it's not going to help you. And what I mean by that is if you're an ostrich and you're sitting on a railroad track and you see the train coming, it doesn't help for you to stick your head in the sand. If you're on the railroad track, you're still going to get hit by the train. This is what I'm telling people. Please, please, please. Take this as an alert, an alarm, a giant neon sign that you have got to start making tax plans now, right now, before things change, because there's things that you can do, what I'm going to talk about in a minute, within tax harvesting, tax swapping, planning out IRA distributions, etc. But we have a train coming, and it is a fast-moving train, and it is a heavy train, and that is the tax train. Well, how does this affect a business? Well, let's look at how this step up in basis loss and this deferral exemption or removal of the deferral of taxes hurts people. Now, I'm not even going to get into real estate because this really affects a lot of people with 1031 exchanges, personal properties, collectibles. It could even mean gold. It could mean primary residences. So the stock, let's use a business for an example. Let's use the stock of a company at death. If it's greater than $1 million, then the tax has to be paid at least 1 year from inheritance. So I'm going to use the example here, a 100-acre farm producing milk, beans, and corn, and let's say that they're selling $400,000 a year in goods. And let's say that they profit only $100,000 per year. And furthermore, let's say that this farm has been handed down through family generations, so they've got land worth about $2 million. Well, we've seen what happened with land and housing in the last year. And so there's virtually no cost basis. So the way that this happens is when the family dies, mother, father dies, the total value of the farm is going to be estimated at about $3 million. There's going to be a total tax due of $1.3 million, and it's due 1 year from the date of death. So where does the family, in this instance, they got land and they've got a farm that's making, $100,000 a year. Where in God's green earth are they going to come up with $1.3 million in tax? Because when that step up in basis is gone, it's like a mini estate tax. Now the estate tax essentially applies to just about everybody. Here's an example too. Let's say somebody has a family vacation home. It's valued at $2 million. Let's say that the annual operating expenses between utilities, taxes, upkeep, repairs, insurance, everything else is $30,000. And let's say that the cost basis is $200,000. This might be a family vacation house that was bought a lot of years ago, or it's passed down through the family generations without tax, right? Because it gets stepped up. The children cannot afford, nor do they want the operating expenses. Upon death, there's $700,000 of tax due. So without selling the home, how in the heck are the kids going to come up with $700,000? Well, like people will say, well, they can take a mortgage. If they can't afford the operating expenses, how are they going to take a mortgage and add additional costs on? Here's example number 3. You have stock and IRAs. You have a modest net worth family, and let's say father dies first, mother dies second. Let's say there's modestly $1.5 million sitting in IRAs, and let's furthermore say that there's $1 million sitting in a home. Let's say that the stock has $1 million in it with a cost basis of $500,000. How do the kids, after the mother passes, how do the kids come up with the tax on the IRA, the capital gains of $200,000, and then the capital gains tax on the personal residence? Well, remember this promise that we had of no taxes for anybody under $400,000. Well, as soon as you remove the basis step up, That's going to tax people under $400,000. The minute you remove the preferential capital gains tax treatment, you tax people under $400,000. The minute the removal of a deferred exchange in excess of $500,000 is removed, you're taxing people under $400,000. Now, in tax planning, there are essentially four separate types of tax strategies. There's deducting and deferring. These are the most common. I mean, you can buy TurboTax and it's going to figure out how to deduct what you need to deduct. You could go to just about any CPA or anybody who reads stuff on the internet. It'll teach you how to defer money. IRAs, HSAs, 529s, 401ks. What are the strategies that no one really talks about, or you probably have to hire somebody to do an analysis to figure out? These are shifting and offsetting. Shifting is where you take assets and income and you shift them to a lower bracket or something that will not be taxed. An offset is where we create an offsetting deduction. An example might be a Section 42 low-income housing tax credit. We put money in that. It gives us a credit. It allows us to come over to the other side and do a Roth conversion. We might put money into a conservation easement. That gives us a deduction 5-to-1 or 4-to-1. We then use that to take money out of an IRA or sell stock, house, or family business. So there's different offsets, but again, this takes a trained eye and a very somebody that really understands how to do all the math, the calculations, and the analysis to figure out which one of those techniques is going to work best. So how about investment taxes? The capital gains problem. What do we do? Well, we can shift. That's called location optimization. This is one of the simplest things that you can do. Make sure that you have the right investments in the right accounts. As an example, it's terrible to put a pure capital gains stock inside of an IRA, because you're doubling the tax from a capital gains tax to a ordinary tax, and you're forcing the sale. Second thing is tax swaps. Moving investments from one account to another account under the 31-day guideline rules to make sure that where it lands is the most tax efficient. Shifting. Simplest way is one thing is taking RMDs. Most financial institutions, financial advisors, when they do the RMDs for clients over 72, what they're going to do is they're going to sell the investments and send a check to that client. Well, sometimes it makes a lot more sense to do what we call selected RMT distribution. Sometimes it makes sense to do that in kind. Take the stock that's at its lowest value or the investment that might have lost money, and you distribute the shares. This way you meet the RMD requirement, but you also move the shares into a swapping position into somebody's account that might have a better tax outcome. Offsetting, tax harvesting. This is something where you can use alternatives to sell one investment and replace it with another immediately. Avoid the 31-day wash rules, but you start building up a loss column that you can use against gains in future years. I tell you what, this is going to be one of the biggest strategies that we use with this change in capital gains and loss and step up in basis. Well, if you have a loss and step up in basis and you have real estate that they don't let you exchange anymore on, or you have appreciated businesses, real estate, farms, ranches, whatever it might be, there are some techniques that we're going to be using here. And again, these are things that need to be planned out. Calculations need to be done to figure out what is the setup cost, what's the ongoing maintenance cost, what are the upsides, downsides, what's the tax saved. So that whatever you're doing, that the benefit is going to exceed what the cost is. But an iDigit is an intentionally defective grantor trust. That's one strategy. A 664 trust. Restricted living gifts. This is where we actually create trusts and we start giving away appreciated property in little bits and pieces, and we pay the gains on it, but at a lower rate so it doesn't all stack into 1 year. And finally, one of the ways to pay the taxes, which actually might be a discounted strategy, is a 7702 trust. My question, what are the financial advisors doing? People are calling us and they're saying, yes, I have this financial advisor over here, or this wealth manager over here. And I'll say, have they done the calculations? Are they looking at what's happening with this? No, they're not giving me any information. Whenever I do my quarterly review, the only thing that they're doing is going, well, this is your performance. Are you happy with that? Do you want to make any adjustments to it? But no one is really addressing the major train that's coming down this track, which is this destructive tax train. We have got to start planning for this. This is my big alert. I said it last year, gave you the alerts last year. Right now, the big train is the tax train. So housing, what's happening with housing? Well, we have the capital gains tax. This is going to definitely affect people and how the housing market works, loss and step up in basis. So what happens is when these events happen and people start selling to get in under a certain threshold, it creates a supply and demand imbalance. There is also a lot of additional supply that we haven't even seen, because what we have right now is we have pent up demand that has driven up the short-term prices. But what a lot of people are not realizing is there's a lot of pent-up manufacturing and distribution. There's distribution due to the virus, due to plant shutdowns. When those are back up and cranking and producing wood, producing building materials, getting labor back to normal and being able to crank out some of the supply that they need, then the demand will go down, or the pricing will go down, because the demand right now is at its peak. That's very important to understand, is that that imbalance right now is what's creating these crazy home prices. And here's something that I think is absolutely, it's insanity. So as you probably have read, the government plans on putting in either between a $15,000 to $25,000 tax credit for a home buyer. What the proposal is that right now is that if you have not owned a home in the last 3 years, you buy a home, they will give you a tax credit, a huge tax credit. And this is not a deduction. This is physically a refund. Now, the government is basically saying we're doing this to give affordable housing to those people that can't afford it. But from what planet did they land from that they think that adding a tax credit is going to help people buy a home? Listen, ladies and gentlemen, what happens is, and it's been proven across every industry, the minute you give a tax credit, look at EV cars. Tax credits. What do they do with EV cars? They jack the price up, because the distributors and the manufacturers know that they can increase the price, because people think, hey, I got this $7,500 tax credit, I can apply to it. It's going to be the same thing with housing. Housing will actually, if this passes, housing prices will even go up more. Now, again, we're studying what that balance is with this pent-up supply and demand and the manufacturing and labor, but it means that housing prices would go up. It's not going to give people an additional ability to afford housing. That will be built into a higher price increase. These manufacturers, these large companies like KB, listen, Lennar, they have analysts back there running the calculations on what they can create a price increase to account for any kind of tax credit. If the government was smart, what they would do is they wouldn't give the tax credit to the buyer. What they would do is they would give the tax credit to those manufacturers and those sellers, saying, hey, we'll give you a tax credit if you produce X number more of efficiency of your product. This floods the market with more supply. The demand is there, but it will not increase prices. It will lower prices. We've seen the same thing within the medical field. Instead of the government trying to pamper, health insurance, I've always said, put more doctors in the market. If the doctors in the market and they have the places to get hired, there's more supply, the demand is there, the prices come down, right? Same thing with the pharmaceuticals. So this is a scary thing, and I don't agree with it, because across every business line, credits to the end purchaser only increase the price. Let's go back to the Roaring '20s playbook, because this is really how we're looking at our algorithms. The virus hits the world in 1919, right? End of 1918, they realized it 1919. We go lockdown from 1919 to 1920, 2021. People get fatigued. They're doing the same things that they were today that they were doing back then, which is people are not wearing masks. They're getting close to each other. They're just sick and tired of being locked up. And what happens is they get out of that house and there's a spending spree that happens. We're seeing it now. You can't buy certain cars. You can't buy certain products. My gosh, you go to a Walmart, you can't even buy a bicycle, right? A bicycle. We are literally like some third world countries where you couldn't get products and services because everybody's out spending money. People are cashing in 401ks. They're buying houses that they can't afford. That will run out. That never lasts, right? It never lasts. So savings runs out, but spending now becomes a habit. Then people increase debt. Back in the 1920s, there was no banking regulation. They could just keep increasing debt. And then what happens when the debt increases in a cap, people look to the stock markets. Back in the 1920s, there was no SEC. So it was an unregulated, wild, wild west situation. And what happened? Stock market crashed in 1929 because there was not regulatory conditions put in there. And that lasted for almost 15 years. However, here's what I want everybody to recognize. In 1929, through the Great Depression, there were more millionaires minted per capita than any other time in history. I'm not saying get scared. I'm saying let's plan for the opportunities right now, because when this cycle runs out, I want everybody to be poised and ready to launch. Let's take a look at the stock market. Well, again, if you're watching this on May 7th, you're a week away, but on here on May 29th, we are up to 42.11 at the close of yesterday on the S&P 500. If we look at that rate of return, it's 12.14% year to date. However, we always think of things in annualized rates of returns. So we're 120 days approximately into the year. That puts us at an annualized rate of return of 36.92% for the year. Let's look at a bell curve, that because a lot of people have been saying, hey, your econ map is really helpful. However, what are you talking about within the stock market? Well, when we look at the stock market and the schedule of when people are getting their money in order to spend, because we still have more stimulus being pumped out, more PPP, more ERC, all these governmental things. They just opened up another $5 billion in another relief program for businesses. So again, there's still a lot of governmental money being printed and being pushed into the system. So we know that at the end of 2020, we had a huge stock market increase, right? And then in January, it jumped. However, we're seeing this jump will probably last until October to March of next year. And then we will see a downturn, okay? The offsets that we have to condition ourselves for is the rent forbearance, taxes, rent, and actually mortgage forbearance, infrastructure stimulus that's still not even been approved yet. That's another $3 trillion potential dollars. And then this home buyer tax credit. Let's look at our current econ map, because again, I'm close to creating a version 7. This is version 6. Based upon each of the factors that have changed within the government and with the virus and with the employment, et cetera, housing. So I'm still estimating that our primary, and I might put pushing this with version 7, I'm still studying some of the numbers, our primary circle of opportunity for real estate is going to happen towards the end of this year, towards the beginning of next year. It really depends a lot on what is going to happen with the taxes, the supply and demand, and the ability for these builders to catch up with that demand. However, I do think that the stock market somewhere towards the end of the first quarter to the second quarter of next year, we're going to take a little bit of a hit. Actions to take right now, not much different. Listen, get yourself into a paradigm portfolio, reduce long-term bonds to short and intermediate-term bonds, refinance, get moving on your reverse mortgage, and start creating a tax plan. Hey, before I wrap it up, if you're not on our YouTube channel as a subscriber, just Google H&H Retirement on YouTube, or you can even Google Wiser Retire on YouTube, and you'll see one of these pages. Just hit the little red button, subscribe, and then you'll get notified every single time that there's an update to our videos. Hey, before I wrap it up today, again, today is a duplicate show. I'm running it on April 30th and on May 7th because I really want everybody to focus on these tax changes that I have created, and make sure that you are not that ostrich in the sand on the railroad track while this giant tax locomotive is heading your way. You've got to have a tax plan that applies to everything, not just your investments, but your cash flows, your real estate, your whole plan. If you have not done that yet, and you're not a client, if you're a client of ours, we've already got you on the slate, already on the project board. Everybody's being slated out for that entire tax plan. But if you're not a client of ours, you can all get an initial complimentary appointment with one of the financial advisors, financial planners. Just call us. It's 844-702-1040. With that in mind, I'm signing off. Have a great weekend. Ken Himmel.